Welcome to the deep dive. When you think about partnerships, business partnerships, what really makes them tick? Is it just about pooling money?
hmm
Or is there maybe something, I don't know, deeper? What if some really old principles still shape, maybe even challenge the way we do business today?
That's exactly right. And today, we're going to explore this fascinating world of companies and partnerships. We're using a pretty unique guide, the Islamic Jurisprudential Standard Number 12 on partnership, participation, and modern company.
Standard 12, okay.
Yeah. Our mission really is to unpack the core ideas of how people join forces to make a profit. We want to uncover the sort of foundational rules, the ones that ensure fairness, define who's responsible for what, and honestly, there's some surprising insights for today's business world.
Right. So we're diving into these core principles, the bedrock of different partnership types. But just to be clear, what won't we be digging into from this standard?
Good point. We're not going to get lost in the weeds of, say, very specific co-ownership instruments or like the super detailed procedural rules for setting up a modern corporation.
Okay.
We're keeping the focus tight on the big ideas, the
Yeah.
different ways people can structure shared ventures.
Got it. So focusing on the why and the how at a foundational level, ready to uncover some maybe counterintuitive wisdom.
So let's do it. We should probably start at the very beginning with what's called a contract company or Sharikah alak.
Sharikah ally. Okay.
Basically, it's an agreement. Two or more people or entities,
Hmm.
they agree to combine something valuable. Could be money, could be their work, could even be, interestingly, their liabilities like their creditworthiness or reputation.
Liabilities as capital.
Yeah, all with the shared goal of earning a profit.
Okay, hold on. That's immediately interesting because usually we think capital, cash, right?
Right.
But you're saying work, effort, even your good name or credit rating, that can be capital too.
Yeah.
How does that change the game? It
Yeah.
feels very modern almost, recognizing human capital.
It really does. It's often an aha moment. By allowing things like, physical work, intellectual skills, or just your standing in the marketplace, your connections, your reputation to count as capital.
Right.
It fundamentally broadens who can be a principal partner. You don't necessarily need deep pockets anymore.
Yeah, it opens things up.
Exactly. It opens doors for partnerships based purely on skill, or maybe ventures driven by someone with a powerful reputation. Think influencers, perhaps.
Yeah.
Their brand is their capital. And it aligns incentives, doesn't it? Your sweat equity, your personal brand, that's your investment on the line.
Okay, that's a great foundation. So let's get into the specifics. The first structure you mentioned, the Aman Company, Shakat Al-Anam, you called it the blueprint.
Yeah, it's often seen as the foundational model, especially for capital-based partnerships. The basics are two or more partners contribute a known amount of capital, profits. They're shared based on whatever percentage you agree on beforehand.
Okay, standard enough so far.
But here's the absolute key point, the thing that really defines it: losses. Losses are always shared strictly in proportion to each partner's share of the capital. No exceptions.
Always. So if I put in, say, 30% of the cash, I have to bear 30% of any loss. You can't negotiate that part.
Nope. You cannot agree to take on less loss than your capital share warrants.
Wow. That's quite strict compared to some deals you see today where people try to cap their downside. It really forces genuine skin in the game, doesn't it?
It absolutely does. It ties your risk directly to your investment, fosters prudence, a real shared fate.
Makes sense. And how are these formed? Is it complex?
Actually, it's pretty straightforward. Mutual agreement, offer, and acceptance, and a clear purpose for the business. And what's quite interesting, even progressive for its time, is that non-Muslim institutions or even traditional banks can participate if the business itself operates ethically according to Sharia principles, and management ensures compliance.
Interesting flexibility there. And the capital, Ras Mal, you called it, does it have to be cash?
Not necessarily. Cash is common, sure, but non-cash assets are fine too, as long as they're properly valued. If you contribute in different currencies, you just value them at the current exchange rate.
Okay.
One really important rule, though. Debt alone cannot be capital. You can use funds in a current account, that's fine, but you can't start a partnership based purely on borrowed money without any underlying assets. Yeah. It ensures there's some real substance there.
Right. Prevents purely leveraged, potentially unstable setups.
Got it. What about managing the business? Who does what? Can partners get paid for managing?
Generally, every partner has the right to act for the company's benefit. Buying supplies, selling goods. But doing things just for personal benefit, like giving company money away as gifts or making personal loans from the till, that's restricted unless all partners agree, except maybe for really small customary things.
Makes sense. And payment for management.
This is a crucial distinction. If a partner manages the business as part of their role as a partner, they cannot receive a fixed salary or wage for that management within the partnership agreement itself. No fixed wage. So how are they incentivized to manage well?
Their incentive comes from potentially getting a larger share of the profit. You can agree that the managing partner gets, say, 60% of the profit, while the non-managing partner gets 40%, even if their capital contributions were 50-50. The reward is tied to success.
Aligns incentives again. But what if you really want one partner to run things day to day and need to pay them a predictable amount?
You absolutely can, but you'd structure it differently. You'd have the partnership agreement and then a separate independent contract for management services. That person is then acting as a hired manager, distinct from their role as a partner, and can receive a wage under that separate contract.
I see. It keeps the core partnership principles clean. Clever. What about guarantees? Can I guarantee my partner won't lose their investment?
Generally, no. Within the partnership, partners hold the assets in trust. It's called a mana. So one partner guaranteeing another partner's capital is usually not allowed. It undermines the shared risk principle. However, you can have guarantees or collateral specifically to protect against misconduct, like if a partner is negligent or breaks the terms of the agreement or acts improperly. That's different.
So guarantees against bad behavior, not bad luck.
Exactly. And there's another interesting bit. A completely independent third party could volunteer to cover a partner's losses without being paid for it. But that third party can't just be like a subsidiary of the partner they're guaranteeing. It has to be truly separate.
Fascinating. Keeps it arm's length. Okay, so circling back to results, profit and loss, how's that distribution finalized?
Profit sharing has to be a percentage of the total profit, not a fixed number. So 40% of profits, not $10,000.
Right.
While you could technically agree to change those percentages when the profits are actually distributed, the ironclad rule remains. Losses always follow the capital ratio.
Always follow capital. Got it.
And final profit distribution only happens after you've covered all expenses and ensured the original capital has been recovered or accounted for. You can make interim distributions, like quarterly payouts, but they're always subject to a final true-up at the end of the accounting period.
Prudent.
Yeah, and the standard also explicitly allows retaining profits within the company, for building reserves or ensuring solvency. Healthy financial management is encouraged.
Sounds very sensible. How do these engine companies end? Can a partner just, bail?
They can end if the agreed term expires or if everyone agrees to dissolve it. But importantly, yes, a partner can generally withdraw just by giving notice. This doesn't automatically dissolve the company for the others. They can choose to continue.
That offers flexibility.
It does. And another point, if one partner wants to eventually buy out the others, they can make a separate non-binding promise to buy the company assets later on, say at liquidation or during the term. But, and this is crucial, they have to promise to buy at market value, not the initial book value or nominal value.
Prevents locking in an unfairly low price from the start.
Exactly. Keeps the buyout fair when the time comes.
Okay, so that's the Shari'ah lanan, the workhorse based on capital. But you mentioned others where money isn't the main thing. Tell us about the Wuju company and the Amal company. These sound different.
They really are. They stretch that definition of capital we talked about earlier.
Yeah.
The Wuju company, Shari'ah al-Wuju, is fascinating. It's a partnership based entirely on credit or reputation.
Just reputation.
Pretty much.
Yeah.
Imagine two people, maybe they don't have much cash, but they have stellar credit ratings or are really well respected in a particular trade. They agree to team up, use their joint reputation to buy goods on credit, and then sell them. No cash capital needed upfront.
Wow.
Profit sharing is by agreement. Losses, they're shared according to the percentage of the purchase price, each partner effectively guaranteed with their creditworthiness.
That's incredible. It's like a partnership built purely on trust and good standing. Maybe like two independent consultants with great reputations teaming up for a big project they couldn't land alone.
Could be, yeah. Or think about traders known for reliability. And then there's the Amal company, or Shirkat al-Amal. This one is a partnership based on work or services.
Okay, so skills and labor.
Exactly. Partners agree to pool their skills, physical work, intellectual expertise, providing specific services. And again, just like the Wuju company, it doesn't require cash capital to start.
So this could be like Two software developers building an app together, or a group of artisans collaborating.
Precisely. They contribute their work. They can contribute different amounts of work, that's fine. They might even use some of their own fixed assets, like tools or equipment, which can remain their personal property. Or the partnership could decide to buy assets together.
It really shows that partnership value isn't just financial, is it? It's about combining whatever resource creates value.
Spot on. These traditional forms are incredibly adaptable in recognizing different kinds of contributions.
Okay, these historical frameworks are clearly very sophisticated, but, the business world today, it's dominated by massive corporations, global markets. How do these foundational FEEC principles translate or maybe clash with modern corporate structures?
That's the million-dollar question, isn't it?
Yeah.
The standard tackles this head-on. It looks at modern company types through the lens of these principles, identifying where they align and where there are significant differences or potential issues.
Right. Let's start with the elephant in the room, the joint stock company, Shari'ah al-Musahama. The big thing for most people is limited liability, right? Capital is shares, you can trade them, and crucially, your liability as a shareholder is limited just to the value of your shares.
Correct. That limited liability is the major departure from the traditional models like Anon, where partners could have unlimited liability.
Huge difference.
It is. For these joint stock companies, the standard notes the contract is usually binding for its term. And yes, shares can generally be bought and sold freely. Things like issuing shares at a premium above par value or issuing new shares later at the current fair market value, those are generally considered permissible.
Okay. Are there restrictions, though? Things that don't align?
Oh, definitely. For instance, financing the purchase of shares using interest-based loans, that would be prohibited based on the underlying Shari'ah principles against interest, right, Ba? And engaging in short selling, selling shares you don't actually own yet, hoping the price will drop, that's also generally not allowed. It's seen as speculative and lacking real ownership.
So no leveraging with interest, no selling what you don't own. What about different classes of shares, like preferred stock?
That's another key area. Generally, preferred shares that give the holder priority over common shareholders in getting profits or getting assets back during liquidation, those are not permitted.
Why not?
It violates the principle of equity among capital providers in bearing risk and sharing reward. Everyone who contributes capital should fundamentally be in the same boat regarding profit potential and loss exposure relative to their contribution. However, shares that offer, say, procedural advantages, maybe extra voting rights on certain matters or administrative preferences, those can be permissible. It's the financial preference that's the issue.
Okay, interesting distinction. Now, moving away from giant corporations, what about the general partnership, Shirkat al-Tadaman? This sounds more like the traditional models.
It really does. The defining feature here is that the partners are personally and unlimitedly liable for the company's debts if the company itself can't pay.
Unlimited liability. Wow, that's serious commitment.
It is. It demands a huge amount of trust. And interestingly, unlike a joint stock company, the contract for a general partnership is typically considered non-binding, meaning a partner can usually withdraw by giving notice, as long as it doesn't cause undue harm to the partnership, unless they specifically agreed upfront to a fixed term.
So high personal risk, but also more flexibility to exit, generally speaking. It feels very personal, like you're truly betting on your partners.
Absolutely. Every decision carries weight because your personal assets are potentially on the line. It encourages very careful management.
Okay, then there are hybrids, right? Trying to mix and match liability. Tell us about the simple limited partnership and the limited partnership by shares.
Exactly. These try to blend the features. The simple limited partnership, or Shirkat al-Tasiyah al-Basita, has two types of partners. You have general partners, they run the show and have that unlimited personal liability we just discussed.
Right.
And then you have limited partners. They contribute capital, but their liability is strictly limited to the amount they invested. They generally can't participate in management, and often their names aren't even part of the company name publicly.
So they're more like passive investors with capped risk?
Precisely. And if there are losses, the limited partners only lose up to their capital contribution. Any losses beyond that.
Yeah.
That falls entirely on the general partners.
Okay. And the limited partnership by shares, Sharikat al-Tasiyah bilashum. How's that different?
It's structurally similar. General partners with unlimited liability, limited partners with limited liability. The main difference is that the company's capital is actually divided into tradable shares, kind of like a joint stock company.
Ah, so the limited partners hold shares.
Correct. The liability rules are the same, though. Limited partners, or shareholders in this case, are only liable up to their share value. General partners cover any excess debt. And again, limited partners typically don't get involved in management.
It's like layering these concepts. Okay, what about something less formal? You mentioned a venture or undisclosed partnership, Shirkat al-Muhassa. What's that about?
This one's quite unique. It's often kept private, like undisclosed to the public or third parties. And crucially, it doesn't have its own separate legal personality or independent financial standing.
No separate legal entity.
Nope. So the partners themselves are jointly and personally liable for its dealings. Think of it like a private joint venture agreement. In terms of rules, it often follows the principles of the Basic Anand Company quite closely. And like the general partnership, its contract is usually non-binding unless they specifically agree on a fixed duration.
So very private, direct personal liability, almost like an informal agreement made formal between the partners, but not necessarily to the outside world.
Something like that, yes. It's used for specific, often temporary joint projects.
Okay, one last one, and this sounds really intriguing. The diminishing partnership, Shirkat al-Mutankisa. It sounds like it has a built-in buyout.
It does, in a sense. It's a structure where one partner basically commits, over time, to buy out the other partner's share until they achieve full ownership. Think of financing arrangements where the financier gradually exits as the other party buys them out.
Right, like Islamic home financing models sometimes use this.
Exactly. But here's the absolute critical point, the real aha moment for this one. That promise to buy out the share. It must be a separate, independent, non-binding promise. It cannot be a condition written into the main partnership contract itself.
Separate and non-binding. Why is that distinction so vital? It seems like a technicality.
It's fundamental. It preserves the integrity of the initial partnership. The core deal has to be a genuine partnership, a true sharing of risk and reward based on something like the NNR principles. If the buyout was a mandatory condition within the contract from day one, it could be argued it wasn't really a partnership at all, but more like a disguised sale or loan agreement from the start.
Ah, I see. The initial agreement has to be a pure partnership first. The buyout is a separate intention, not a contractual obligation defining the partnership itself.
Exactly. So this diminishing partnership still has to follow the general rules, like the partner being bought out doesn't have a right to just demand their capital back from the company itself unless it's properly liquidated or per the separate agreement. Profits and losses get adjusted periodically as the ownership shares change. And interestingly, it's permissible for the partner buying the share to lease the portion they don't yet own from the other partner, paying a rental fee. That helps manage cash flow during the transition.
What an incredibly detailed and, frankly, ethically consistent journey through partnership structures. We've gone from the foundational Anand company, based on capital, to the really creative Wuju and Amal companies built on reputation or skill.
Right.
And then seeing how those core ideas are applied, adapted, and sometimes challenged by modern forms like joint stock companies, the various limited partnerships, and even that nuanced diminishing partnership.
It's really quite something, isn't it? This deep dive, I think, really highlights how these frameworks, developed over centuries, aim for fairness, transparency, accountability, always trying to balance that shared risk, make liability clear, and, crucially, keep different types of agreements distinct and uncompromised.
Absolutely. So for everyone listening, having explored these really sophisticated, principled ways of looking at partnerships where even reputation can be capital, where loss sharing is non-negotiable in some forms, where buyouts need careful separation, how does this challenge or maybe affirm how you think about business structures today?
What does it make you consider?
And maybe more importantly, what new possibilities could these old yet incredibly relevant ideas inspire for creating more equitable, more robust ventures in whatever you're involved in? Something to think about.